Myself, I'm Corey Dutton. I'm a private money lender, and I serve 13 states in the U.S., focusing mostly on the Western U.S. I want to introduce the star of our show today, Rocky Burtani, and let him introduce himself.
Thank you, Corey. Thanks for having me. Hello, everyone. I'm Rocky Burtani. I'm the founder and CEO of Private Lender Link. It's an online platform that connects brokers and borrowers with private mortgage lenders throughout the country. I started the website back in 2010, and it's evolved quite a bit. Right now, there's about 135 lenders on the platform, and it's also got a directory of investment opportunities, service providers, capital providers. So it's evolved over the years, and I have relationships with most of the lenders. We don't list every single lender out there on the platform, so I've taken the time to try to vet every lender and form relationships with them. And although there's about 135 lenders listed on the platform, I have relationships with well over 200 lenders, and I've been in touch with them quite a bit over the last few weeks to find out what their status is, and happy to share some of that information with you.
Well, guys, let's jump right in. We've got about 27 participants on the conference today, and I know everybody is super eager to hear about the changes in hard money lending since the lockdown from COVID-19. I thought Rocky would be the first person that I wanted to bring on today to answer questions for you guys about how these changes could affect your real estate businesses. Because this guy is in contact with so many hard money lenders. I mean, he knows everybody. He's probably one of the most connected people in the entire hard money lending industry. So the first question that I wanted to pose to you, Rocky, is how have the guidelines for fix and flip loans changed since this COVID-19 lockdown started?
So the primary change with fix and flip loans is the leverage. So loan to cost, most lenders were requiring only about 10 or 15% down payment on the purchase, and then they would fund 100% of the renovation costs. So first of all, the loan to purchase has come down to 80% maximum. Some lenders even lower than that. They'll want the borrower to bring in 30 to 40% of the purchase price, and that may vary depending on their experience and the location. So let's just say 80% loan to purchase is the max. And even on the rehab costs, although some lenders will still fund up to 100% of the rehab costs, I've heard of some lenders even requiring the borrower to put up about 20% of just the renovation costs. And then the maximum loan to after repair value is 65%, and that also could be lower for some areas. So besides the leverage, the experience is very important. So all the lenders I've talked to won't consider any newbie real estate investors if they've only done 1 or 2 flips in the last 2 years or the last 1 year. They probably won't be considered, but all the lenders are looking for more experienced investors now, and that's the other primary difference. Some of them even now care about the credit score. So borrowers' credit score was always something that the lender would check before, but now a lot of lenders are saying, okay, well, even if you have the experience and you've got the down payment, we won't lend to you unless you've got at least a 640 credit score.
Right, right. We've noticed that as well. We've kind of been seeing that change. On the fix and flips, though, Rocky, so are you, the majority of your lenders that you've talked to and surveyed in the last couple of weeks, is it the majority or is it all of them that have changed their fix and flip loans?
It's probably about 98%. There's only 1 or 2 that I've talked to that said they haven't changed anything, but I have a feeling that even though they say their guidelines haven't changed, when they actually get a loan request in, they're probably going to be more conservative.
One lender in particular, I know they're called Temple View Capital. They've been doing a 90% of purchase price, 100% of repairs as well, similar program to what we've been offering. And I spoke to one of their account representatives this week, and he told me that they've lowered it down to 75% of purchase and 100% of repairs. And get this, they will only lend you money if you've done 5 or more flips in the last 24 months.
Yeah, I'm not surprised.
So that's quite a bit. And then my next question I wanted to dive right into was, how have the guidelines for bridge loans changed. And guys, when I say bridge loans, I just mean these are not fix and flips. These are usually reserved for rental properties or other property types where the lenders are just going to loan you a percentage of the purchase price. There are no repairs.
Yeah, so what I'm seeing with bridge loans is the max is still 65% of the value or the purchase price, but more realistically, most lenders are maxing out at 60% of the value. And when they look at the value, they're looking at maybe what it was valued at in March or even now, but using comps that are date back to maybe February. So 60% is typically the maximum.
Wow, it's gone all the way down to 60% of the purchase price.
Yeah, and also
the value.
Yeah, and also the loan term is another factor. There's some lenders I know that would have typically gone up to 4 or 5 years with a loan term, and now they're maxing out at 2 years.
Wow. Wow. To give them a little bit more of a buffer in case things change more rapidly than people think they could change.
Correct. And they're looking, I mean, they're looking at the market knowing that or thinking that values are going to drop in a few months. And that's the reason they're being a little more cautious. But even prior to the current situation, a lot of lenders I talked to that did any kind of refinance or cash out. Cash out's always one thing that the lender is not that excited about. You know, they want to know why you're cashing out equity, and they're always a little bit more conservative on a cash out loan versus a purchase.
But now it sounds like even more so, if they're even doing them at all, they're definitely going to be more conservative. It sounds like around 60% of value. And then another popular loan program that has been pretty widespread in recent years, being offered by a lot of hedge funds, is a 30-year rental loan product that's been super popular with real estate investors that are buying rental properties. Is anyone still funding these 30-year rental property loans, Rocky?
So I've only found one lender that's still doing the 30-year rental loans, and they've been doing them for a long time, a lot longer than other lenders in the market, where most of the national lenders, because the hedge funds were buying them, that it really only started in late 2018. But I found one company that's based in the Midwest that offers this 30-year rental program for properties in the Midwest and the Southeast. They won't touch the Northeast or the West Coast. And so they've got about 25 states that they lend in, and they're still offering it. And they don't typically sell their loans to hedge funds, or I'm not sure what their capital structure is, but they said they haven't been affected, and they're still offering that product to real estate investors.
So for those that just joined, I asked Rocky who's still funding the 30-year rental property loans. Rocky, are any lenders funding specialty commercial properties?
There are a few that I found. For example, there's a lender out in Michigan that lends nationwide. Their minimum loan amount's $2 million, and they're still doing hotels. They'll still do assisted living facilities. That's always been one of their favorite asset classes. They'll still consider retail. When you get a little bit more specialized in that, you know, you may be talking gas stations or car washes. There's still a few I found that will consider them, but their loan to value is way down on those. Even hotels, if someone would have initially or prior to last month would have considered up to 70% on a hotel, that might come down to 60 or 50%. But I did find a few that are still doing those.
So that I wanted to just summarize that, folks. For lenders that are doing those specialty commercial properties, you know, we talked about, he mentioned hotels, you know, gas stations as examples. The loan to value ratios have gone down on those. What does that mean? That means the amount of the loan that the lender is willing to give you against the value, or if it's a purchase, the purchase price. So that's gone down. You know, in the last few years, some lenders have been lending up to 90%, but Rocky has just said that a lot of them have gone down to 60% of your purchase price or your appraised value. That's scary. What about ground up construction, Rocky? What have you been hearing about lenders that typically do those ground up construction loans?
I found only a few that would still consider a ground up construction loan right now. And these are lenders that historically have preferred construction, or it's been one of their primary types of loans that they fund. So those lenders are still lending in certain markets. Like, for example, there's a lender in Colorado that only lends in Colorado, Arizona, Texas. They're still active, and they've always been very bullish on commercial or on construction loans, and that's their primary loan type. So they're still doing those. They also don't mind taking over construction loans from other lenders. And there's also a lender based in Washington state that lends in 4 markets throughout the country, and that's all they do is construction. So they're still doing them, and they didn't indicate that they're changing their leverage points, but they are looking more at experience at this time.
Oh, definitely. And cash, I'm sure more cash to bring into the deal, more cash equity from the borrowers to bring into the deal. That's what we're kind of seeing across the board.
Correct.
And then I think one of the questions that everybody's really wanting to know about that's on this call today is across the board and all the loans we've discussed, from fix and flips to ground up construction loans, has pricing changed, you guys? And when I say pricing, interest rates and points, has pricing increased?
Yes, so a lot of lenders are increasing their pricing, and some of them are doing so because there is less competition. So a lot of the lenders that are still actively lending right now are getting bombarded with a lot of loan requests from all over the country, or from fallout from the other lenders that have halted. So because of that increased competition, they're increasing their pricing by typically 1%, maybe up to 2%. And if they, let's say, for example, construction, if construction is not something they're really excited about, but they get a good loan request in with a strong borrower, they may increase their points and interest rate on that, just because it's not really their favorite type of loan, but they'll still do it.
And some lenders have just stopped lending altogether or have paused their lending. A few examples that, and I've taken this from brokers that have been submitting us loans in the last few weeks, guys. So, if anybody from these companies is on the call, feel free to join the chat and correct us if we're wrong. But a couple of brokers have shared with us their fallouts in the last few weeks for loans they want to try to get funded. And the list includes Corvest, which is a really big one, South End Capital, Velocity Commercial, and 5 Arch. Those are just a handful of lenders that have just stopped taking applications. Now, whether they are just on pause, no one knows right now. And have you heard that same thing, Rocky, from some of your private money lenders, that they're just not lending or they're on pause?
Yes, definitely. Any lender that typically you'll hear them say that, oh, we lend nationwide, or they lend in 40 plus states. Most of those are on hold. And it's really, I haven't seen any that just said, oh, we're completely shut down, we're going out of business. It's more that, hey, we're halting, we're not taking any loan applications. We'll get back to everyone in May or June and see if anything changes.
But why? Why have these lenders stopped or paused their lending? I know the answer, but I want everybody on the call to understand that.
Sure. So most of these lenders are selling their loans to a Wall Street backed company or a hedge fund. So it's all about the secondary market. Any lender that's selling to the secondary market, those loan buyers have halted because their investors are a little concerned about the market, and they don't want to take on additional risk. Everyone's anticipating that because values may drop, they're going to have to tighten up their credit box and not do these higher loan to value or loan to cost loans. So it really starts from the real capital sources, which is a secondary market. And because all of those loan buyers have just said, hey, we're not buying right now, we're going to wait and see what happens, then all these lenders that their entire business model is to sell these loans to those Wall Street backed companies or hedge funds. That's why they're holding off, because they, even if they have the money to fund the loan with their own balance sheet, they're going to get left holding those loans, and they can't keep recycling their capital. So that's the primary reason. And you kind of touched on what differentiates the lenders that are active right now, like my company, versus the ones that have stopped lending. You kind of touched on it, but I want everyone to understand, when Rocky says capital structure, he means where does a lender get its money to fund these loans? Sure. So the lenders that are still active have a different capital structure where they're not funding the loans and then selling them off. And there's two primary structures for that. One is they may be a debt fund, and they've already got access to the capital. All these investors have pooled their money together, and the fund manager still has the funds. And you know, some of those investors may try to withdraw their money out of the fund, but it doesn't happen instantaneously. So those debt funds still have a lot of capital, and they're in a pretty good position. So if they're not a debt fund, the other structure is a lender originates the loan, and then they have a network of high net worth investors or family offices that will fund the loan at closing, or the lender may originate the loan, fund it with their own money, and then you know, sell the loans to their individual investor, or their family office investor, either as a whole loan, or they could fractionalize it. So typically anyone who's backed by a high net worth investor, or family office, or if they're a debt fund, those lenders are still in a good position. And now their investors are wanting to get higher rates and higher yields, because over the last few years, when all these, you know, hedge funds and Wall Street backed companies have come into the space, a lot of these individual investors have been neglected, and they've had to reduce their yield. So if they're used to getting 10% return on a hard money loan, they've had to come down and down just to compete, and just to get something, and just to put their money out there. So they're still in a good position, and now they're getting a higher yield than they have been for the last 4 years or so.
Right, guys, because it's the supply and demand. You know, the more money that's in the market, and there's been more money in the market to go after private money loans than ever before in US history. One of the largest private money lenders in the United States that you guys have all heard of is Quicken Loans. That's a private money lender. So there's been more private money in the market than ever before in US history. And when there's a ton of supply, then the cost of these loans is going to go down. The interest rates go down, the points go down, and the leverage goes up. And when I say leverage, I mean they're willing to lend you a higher loan amount against your purchase price or your value if you already own the property and you get an appraisal. Now things are a little different. There's not a lot of capital in the market. These investors are afraid to buy these loans. They're afraid to fund these lines of credit for these larger lenders like Corvest, like South End Capital, like Five Arch Capital Partners. So what's happening? They don't have money to lend. They're locked down for the moment. And so the lenders that do have money to lend, it's supply and demand. They're going to charge you guys more money or a higher interest rate for that money. And then the final question that I wanted to ask you, Rocky, and then I want to launch into some of these questions that people are posting here. Guys, go ahead and post your questions into the chat right now so that we can start answering those. But my last question for you, Rocky, is what are the lenders you've talked to anticipating will happen over the next few months?
So a lot of the lenders I talk to that are still active, they're anticipating that values will come down, probably starting in the summer. Once the shutdowns throughout the country are done, then they anticipate the values coming down, and they still expect to have a demand for private money loans, but the entire landscape is going to be different, and fix and flip may still be a big sector of the market, but lenders are worried that there's not going to be enough end buyers for those flipped houses. So volume is going to come down, and they're still anticipating that the rates are still going to be a little higher than they were prior to March, but it's really the valuation. That's a really big thing for most lenders. I know some lenders that are very well capitalized. They have the money to lend, but they're on hold only because they're a little concerned about how to value the properties, and maybe if a deal came along where it's 40% LTV or 30, then maybe they would do that loan, but their standard lending guidelines, they're just worried about values coming down. So valuation is the big deal.
So Adam Steinberg asked, and it's a real good segue into the glass question. Adam Steinberg asked, do either one of you see the lending coming back to those high leverages, or do you think this is now the new norm? more experience and more money down.
Yeah, I think this is the new norm. I don't think those days of newbie investors coming in and putting 10% down, from my perspective, I don't see that coming back.
I think that you're gonna have people that are gonna come back to doing those high leverages because they want to compete in the market and they're willing to take a higher risk. So like Rocky was saying before, he does have some lenders that are saying, oh, my guidelines haven't changed. Well, those lenders, I think, are still going to be offering the high leverage loans because they want to take a larger market share. But I think most lenders are going to stay really conservative over the next 24 months till they can see what's going to happen. I think that those interest rates, though, are not going to be the same. For the lenders that haven't changed their guidelines, they may be lending at a higher leverage, but I think they're going to increase their interest rates and their points because nobody else is going to be offering that high of leverage anymore. So I think everybody's going to have to, if you want the 90% of purchase and 100% of repairs, you're probably going to have to pay a higher interest rate and points for that. I had another question from Scott Anspech that said, what are you seeing in required reserves? Or have you had a lot of your lenders saying that they're going to ask for higher cash reserves from their borrowers?
Yes, great question. And I forgot to address that earlier when we were talking about the guidelines for fix and flip loans, but I'm also hearing that from other types of loans. It's not necessarily only for flips. It's actually even more of a concern for lenders for a rental property, a refinance, where lenders are asking for 3 months of interest reserves, or not even reserves, 3 months of interest payments up front that are paid at closing. And if they don't require the money to be paid up front at closing, they want to see that the borrower has the liquidity, and they want to see bank statements and make sure that they have enough money to pay all the interest payments for the entire loan amount, and at least that money sitting in their bank. So that is definitely a new thing I'm seeing, and thank you for asking.
Thanks, Scott, for that question. We have been looking more as a hard money lender ourselves. We have been looking to see kind of what the cash reserves. And in fact, we've never asked that question. We're an asset-based lender, but every loan, we've actually modified our loan request form over the last few weeks to ask that question in the initial loan request. How much do you have in reserves? Because we just want to make sure that if flippers have to hold these properties longer than they think, let's say the property's taking a little longer to sell, do they have the cash reserves to get them through that time? And if it's a rental property, and let's say they have persistent unemployment and they're going through a high turnover of tenants and they're not paying their rent, do they have the cash reserves to get them through until that rental property is stabilized? So that's one question that we've been asking. Another question that someone asked is, what percentage do you believe values will drop by? Obviously, we don't have a crystal ball. We don't know. I'll start out with answering that question. Again, this is just my opinion, guys, and gals, based on what I'm seeing as a hard money lender, and looking at hundreds and hundreds of deals every week the way I do, and studying the markets and studying what's happening globally. A lot of people aren't paying attention to what's happening in these other countries like I am, but I'm paying attention to the whole big picture. And I think that commercial real estate has been grossly overvalued the last couple of years. So I could see commercial real estate values in some cities and some property types. Obviously, it's not going to be all property types, because some property types in commercial are going to be winners in this because of the changes in our economy. But I think some property types in some cities will see 25% price declines in commercial real estate. In residential, my personal opinion is that some markets will see 20% price declines by the end of 2020. And why do I say that? Well, let me give you what facts and data that I'm using to draw this from. The first thing is the unemployment. We've all seen a massive amount of unemployment in the last few weeks. And I see this a lot, you guys. I see people comparing the unemployment numbers with the recession of 2008. And guys, you cannot compare this with what's happening now with that recession. Why? Because the fundamentals are so different. I mean, we had months to prepare for this last recession, some of us, because some of us saw it coming on the horizon. you guys, this time we've had weeks to prepare. And I want you to think about another factor. That unemployment that happened in the last recession, it happened over a period of time. We've seen all this employment happen all at once in the last 3 weeks. So what is that going to do to people's credit scores? And what is that going to do to their ability to qualify for a loan to buy your fix and flip? Okay, if you're a fix and flip investor. So what's that going to do? It's going to shrink the buyer pool down. And when there's less eligible buyers to buy more properties, what is that going to do to prices? It's going to drive prices down. Now, a lot of people are throwing out this supply and demand. There's so much demand for housing. And, you know, in Utah, I hear all the time from realtors in Utah saying that, you know, the demand outstrips supply by like 3 years. Well, guys, the one thing you need to realize about that, though, is when your buyer pool shrinks down, less people are able to qualify than were before. So now you've got all these buyers that were qualified and they were ready to buy a home, but guess what? Now they can't. So what does that do to your supply and demand numbers? And then the other factor that I want you guys to consider in all this is that you have now people that cannot afford these homes. We've gotten to a point in the market over the last few years where prices have continued to go up and up and up and up. And what is that doing? It's making it so people cannot afford a home. They just can't. Most people cannot afford to buy a home over $450,000. So what do I think? I think that we're going to see probably price increases in the affordable home category, which is going to be below $350,000 in Utah, and it differs by city and by state. I think the affordable home category is going to stay strong, and we may see some price increases. But the thing that you guys all need to remember is, with the Fed printing money, we're going to have massive inflation from this. So you need to factor in what the inflation rate is to this growth that you supposedly think you're going to see. And you also need to realize by the end of 2020, whatever the estimated inflation rate is, you need to factor that into your growth. So let's say the market declines by 10%, but inflation is 15%. You need to factor that into your numbers, because you're not dealing in reality if you don't factor in the rate of inflation into all this, because we are going to see some massive inflation from all this money printing. Now, I'm going to let Rocky answer. I've given you guys my opinion on how much I think price declines in residential and commercial. What do you think, Rocky?
From what I've heard from a lot of the lenders I've talked to, and I kind of agree with this, is a lot of the lenders are thinking that values are going to drop by anywhere from 15 to 25%. And for residential, it may not be hit as hard as commercial, but like you said, Corey, commercial real estate is going to take a big hit, and it spans across different sectors. Like office may take a big hit. Retail has been battered for the last several years. They're going to get hit as well. So commercial real estate, probably 25%. If you just want to take one number across the board. And for residential, you know, most people think anywhere from 15% up to 25%. Maybe the urban areas may be stronger than the suburban or rural areas, but even the urban areas may take a hit. There's articles I've read about anticipation of people leaving the cities because they don't want to be in densely populated areas anymore, and they're going to move out to the suburbs. But wow, as far as numbers, 15 to 25% is what I'm hearing from most people.
And I had somebody ask a question, and they seem, it's kind of like a call for help. Team LV asks, how will people be able to get into the industry if no one will lend to first timers? That sounds like a lot of frustration there, and I feel your frustration.
Yeah, it's you know, I guess maybe if you could look back to 2008, where there wasn't as much activity. I guess maybe there were still some new real estate investors getting into the market, but it's still, I think maybe it's just going to be a cycle that they're going to have to wait until there's more capital in the market and there's more lenders that are willing to you know, to loosen their guidelines and lend to first-time investors. You know, that could take a few years, but I don't think that's going to really change a whole lot.
My answer to that is, be patient. I will still lend to first timers, because a lot of my first timers have mentors helping them. They have a good team of people. They've gotten involved with a real estate group, like their local RIA or their local real estate club, or they're part of a larger educational group, and they have a support system. So I know that there are lenders that still will lend to beginners. I am one of them. And I know that there's a lot of other lenders that will as well, but you've got to make sure, hey, you've got a good team, right? You've got a mentor that can help you through this, and build your cash reserves, borrow money from mom or Aunt Betty and have that money sitting in your account. Offer mom or Aunt Betty a second mortgage position on this property, so they get a secured interest in your deal. They're not just handing you the money, and then you can show that lender that you've got that cash sitting there. And I think that that will give them a lot of confidence. I had a question from Justin Puchar. Is 25% hit on apartments also? And how do you estimate difference in 2 to 4 unit decrease? I think, the jury's still out on multifamily, Justin. I mean, multifamily is one of those, it's kind of like senior housing in my mind, that it's kind of a 50-50, because it may end up leveling out, because yes, you'll probably see some price declines. I read in National Real Estate Investor today an article about multifamily price declines. But I think it could level out, because you've got more people that can't qualify for a loan now to buy a home. So they're going to be renting, right? But you're also going to have people not paying their rent, which means people that are looking to buy apartment complexes may want to wheel and deal more and may not be willing to pay the price they were willing to pay back in November. What do you think, Rocky?
I think multifamily is also probably going to take a hit. And from my perspective, it seems like a lot of the new multifamily buildings that have been built over the last 5 years or so have been more for, not necessarily C class. I mean, I guess in terms of the rents, they've always gone for the higher end, or the more amenities, and then the B and C class, or the older multifamily properties, were getting bought up by multifamily investors that wanted to rehab them, and I think those are going to be a little bit more easier to rent now, and it just seems like there's a lot of supply. Although everyone who's in multifamily, and you see all these buildings popping up all over the country and these massive apartment complexes, if there's still a demand for housing, sure, there's enough supply for it, but I think all the rents are going to come down.
I had another question. How long do you anticipate the dip in pricing will last for the residential market? That comes from David Goldstein. Thanks, David. Appreciate it.
That's a tough one.
I've heard up to 2 years
yeah,
from some experts.
yeah, at least I would think.
I think it's going to last. I would say that this is probably going to last. The jury will be out on a lot of these property types for the next 2 years, 24 months, I think. But I don't think, a lot of markets may not see any price decreases by the end of 2020, whereas some may, because think about how long the real estate market takes to react as compared to the stock market. There's no comparison. It just takes so much longer for these fundamentals to sort of catch up to the real estate market and shake out, as is what I call it. How is it going to all shake out? And it takes time in the real estate market. So I think sometimes some markets we may see it take a little bit longer to go down, and some might go down quickly. I mean, I was on a call 2 weeks ago now, and one of the presenters was trying to sell a duplex at 340, and somebody on the call actually chimed in and said they bought that duplex for 310. So what is that? That was over, I think he said that it was a 2-week time frame from when he listed that property to when he had it sold. And that was right after the lockdown. So what is that, 8 or 9% right there? So some markets will see a little bit quicker price reductions, and some may take a little bit longer to last. One thing I want to pose to everybody out there again is you really need to factor in inflation when you're looking at these price decreases or price increases, always. And that is going to be a major factor here coming up in the fall. We're going to start to see that inflation kick in. You're really going to feel the pain when you go to the grocery store. So you need to realize that that's all across the board in all products and services that we're going to see that happening.
Yeah,
Um,
I'm
Go ahead.
surprised. I'm surprised that a lot of people are still considering acquisitions. You know, from all the lenders I talk to that are sitting on the sidelines waiting for, you know, to see what happens with values. You know, if I were a real estate investor, I'd probably not look at purchasing anything because you never know. It could, you know, you have that scenario you described where it dropped 8 or 9%. What if maybe by the summer or the fall, you know, things get even worse and people start moving around and we see what happens with the industry and tightening credit from the banks, and you know it may drop even more. So I'm shocked at how many people are still looking for properties to buy and think they're getting a good deal today, but you know what if values keep dropping?
Right, right. But there will be some deals to be had. I've heard a lot of people saying that no, the foreclosures aren't going to happen. The government's going to prevent the foreclosures from happening. Well, maybe that's the case, but what if we see a lot more short sales? All of you people out there that were versed in short sales in the last financial crisis, you better get your tools sharpened, because we're probably going to see a lot more short sales hit the market. Maybe not as many foreclosures with all the forbearances that are happening. But the one thing I want to throw out there to you is, what are the first things that these people are going to stop paying on? If they get a forbearance on their mortgage, but they may not make the payment on that boat, that ATV, that second home, that credit card bill, right? So that's something that's going to hurt their credit, and they may not be able to qualify for a loan, which, like I said, that's going to shrink your buyer pool. We had a question: would you guys anticipate loans to have longer repay periods? That comes from Jeffrey Mora.
Longer repayment? Are we talking about short-term private money bridge loans, or is that? I mean, I guess I could see lenders extending to whatever they need to make sure that the project completes and that they get paid. I don't, you know, unless they have a capital requirement or a capital provider that says, hey, we have to get our money back in this amount of time. I could see a lot of lenders extending their loan terms just to accommodate people and not have to foreclose.
And guys, what I will say on that is, you know, I offer usually a 12-month loan, even to my fix and flippers, as a minimum, because why? I don't want them to have to pay more money to extend. So one thing I will, you know, caution anybody here that's listening is, do not take a short-term loan right now. Even if you think you're going to sell that property before the end of summer, do not take a loan that is shorter than 6 months. Or I would even say, don't even take a 6-month loan. Because think about it like this: some of these lenders, once you get past the 6-month mark, they're going to charge you 1 point a month to extend. I seriously have seen that. So please just err on the side of caution, and don't take anything, in my opinion, shorter than 12 months, because you could be setting yourself up for a whole lot more cost down the road. Corey Jones asked, this is a great question, by the way, do you think luxury real estate is more insulated against this downturn due to the type of end buyer who can actually afford that product? And he uses an example of a resort area.
No, I think those luxury products are going to be in trouble. I mean, it usually is, especially in a resort area. Like you said earlier, those are, you know, the primary residence is always the you know, the priority, but you know, the second home or you know, unless it's their primary residence, I'm not sure, but I think any luxury product is going to have some issues, or there's not going to be as much of a demand, and there's going to be fewer comps, and lenders are going to be less willing to lend on them.
Right. So, and that last thing you said, less loan products available, stricter underwriting requirements. I forgot to mention that before. When I said that buyer pool could shrink because of credit and unemployment, that's another factor that I forgot to mention. Many lenders have stopped making jumbo loans. And I want you to look up on your, in your browser, do a search for jumbo loan limits by county, okay, in your state. And see what that jumbo loan lending limit is, because a lot of those loans have gone away, and it's because of what we talked about earlier about the capital market crisis that we're in. Nobody's funding these lines of credit, nobody's buying these notes on the secondary market, and so that's why the jumbo loans have now decreased. And so Corey Jones, who asked that question about the luxury real estate, all the jumbo loans are going to fall in that category. Now, the demand in these areas is so high for people that just want to live there as their primary home. So I think that you're going to see a continuous strong demand for the affordable housing, even in those areas, because people want to live in those areas. And there's always a high demand for affordable homes. But with the jumbo loans going away and lenders increasing their underwriting requirements, requiring more money down, higher credit score, more cash reserves, there's going to be less loans available. So that's going to shrink your buyer pool for those higher end homes. What do I think on the higher end homes? Well, everybody that has money, their stock portfolio has taken a major hit. So they're probably not going to be buying second homes or vacation homes in those markets. So yeah, I definitely think that there's gonna be some price declines in those luxury markets. I had a guy bring me a deal last week. It was 3 townhomes in Salt Lake City that he was looking to purchase from the builder who ran out of money. And these are luxury townhomes that he was looking to turn around and list at $750 each. Well, there's a lot of inventory for luxury townhomes, and not a lot of buyers that can qualify now with those jumbo loans going away for the most part. So do I think that that guy could get stuck holding those? Absolutely. And I told him to run, because you're not going to have people buying those second homes in those expensive properties because they've lost a lot of money in the stock market, or they may have been laid off from their job. You guys, I want to pose this to you. What if you had a business on Main Street right now, and on May 1st, the state says you can open up your doors again and start serving people? Are you going to hire all 30 of those people back? No, you're not. You're going to go to a skeleton crew, and you're only going to hire your linchpins back. You're going to hire your service-based people that are out on the street performing those services and delivering those products. You're not going to hire back everybody. You're going to, I know a business owner that has 15 employees, and it was him and his wife that started this company. And I talked to him, it's now been about 2 weeks. And I said, what are you going to do? You know, are you going to hire everybody back? Like, what's your plan? And he said, Corey, it's going to be me and my wife running this company, and we're going to hire one person back until we see what this is going to do. So that 15 employees now went down to 1, and him and his wife now coming back into the business and running things to see how things are going. So those middle managers that could afford to buy $500, $750 million homes, a lot of them won't be returning to work. And now you've got some businesses that will not reopen their doors again ever. And then you've got the example of my buddy's business where he had 15 employees, and now it's going to be him and his wife and 1 employee. Now there's going to be more people looking for less jobs. So more competition for fewer jobs, because like I said, some of those businesses will never reopen again, unfortunately. So any other questions? Did anybody else want to throw out any other questions at us? Again, none of us have a crystal ball, but we're just throwing out at you guys what we're seeing. I did have one last question, Rocky. I wanted to see if you wanted to try to take a stab at this.
Okay.
Any opinion on what may happen in the Vegas market? I know Vegas has just seen a total economic shutdown.
Yeah, Vegas is probably going to have a tough time for several months, but you know, I hope that it opens up, because I love going to Vegas for all the industry conferences, because you know, no matter where they are, I'll still try to go to them. But I don't think they're going to start opening up, and I don't think people are going to start getting comfortable with traveling again, maybe until the fall, I hope. And even then, you know, maybe it's just not going to be as busy as it was. But Vegas Vegas unfortunately is going to take a huge hit. You know, they've seen really good increases in values and demand, and a lot of people have moved there over the last few years, especially from California. But yeah, they're going to be hurting, unfortunately, as far as employment goes, and then that's going to affect the values. But I really hope they open back up and start thriving again.
Kat Swab asked, would you advise us not to do investments now? No, I think there's always going to be opportunities no matter what, whether the market's overvalued or undervalued, there's always going to be opportunities, Kat. So keep your eyes open and looking for short sales, looking for opportunities. This is when a lot of wealth is going to be transferred, and a lot of people that can spot these opportunities and take advantage of them are going to make money, and they're going to thrive. So definitely do not think that now is not a good time to invest. It's just you need to pivot and you need to reevaluate your investment strategy to be the most successful. I think, some of the winners could be, warehouse properties. Justin Puchar asked, where do you see the biggest opportunity for investors? I think short sales are going to be up and coming on the residential side. I think warehouse properties could be a good property type to look at getting into. Data centers, clearly. Multifamily, the jury, like I said, is still out on that, because you're going to see more people that are going to be looking to rent. But then you're also going to see a little bit of price declines because buyers just simply won't pay for a property that they think is going to be under rented, or they're not going to even receive rents. What are you thinking as far as opportunities, Rocky?
Like you said, I think there's always going to be opportunities in different sectors, and I think industrial is going to make out pretty well, because everyone's, even in the last few years when e-commerce has boomed, and industrial's had a really good run because everyone's looking for a distribution location. It's hurting right now because commerce is essentially stopped, and all the port cities are hurting. But I think industrial is going to be a good place to look at. Self-storage is always pretty safe, whether times are good or bad. People need storage, and it's one of their lower expenses on their list, so they're always going to need to store some stuff. So self-storage is good, but even with single-family homes, like you said, if you can get a really good deal, and you can anticipate, look at the numbers and just maybe think like a lender. That's usually what I do, because I talk to lenders all the time, is be conservative on the numbers and anticipate the values are going to come down, and there's going to be deals out there. There's going to be a lot of investors that are just going to throw their hands up and say, hey, I need to get out of this, bail me out. So I think there will be a lot of opportunities in the next few months.
Right. And you guys make sure that when you're evaluating these investment opportunities, whether it's a fix or flip or a commercial property, factor in possible price reductions into your numbers. So if you're getting comps for after repaired value on a flip, for example, make sure you factor that in to your final numbers. What we said here, maybe 10 to 20% of that ARV. If your after repaired value is 550, maybe decrease that and look and see if that deal still makes sense for you if the prices go down by the end of 2020 by 15 to 20%. Calculate that in. And then on commercial properties, look at your NOIs, which is your net operating income, really carefully, and do a lot of different modeling for how that could play out over the next 24 months. If we see some persistent unemployment, which I anticipate we will, because I talked about those Main Street businesses, with 30 employees, you're going to have less positions available and more people vying for those positions. So factor in vacancy rates, factor in your numbers and your final net operating income when you're looking to purchase a property. But yeah, I think there's going to be opportunities, because if somebody doesn't have sufficient cash reserves and they go down to 40 to 60% occupancy when previously they were at 80, and then of those 40 to 60%, how many of them are really paying? Maybe 25, 30% are actually paying. Those people might be motivated to sell, and they might be motivated to sell at a pretty good discount. So if you've got cash or a lender like me to fund your deal, you could be in a really good position to get a good deal. So I definitely think that there are going to be some opportunities for those that are ready and have the cash available or the funding. Well, I think that's it. I would encourage all of you to go to privatelenderlink.com. Check out Rocky's website if you never have before. It is an awesome resource for you to get exposure to a lot of different lenders that are lending in your spaces, so that you can get a lot more funding lined up for the opportunities that could be awaiting all of you. And our company's privatemoneyutah.com. Submit a form on our website or call us anytime. 435-565-1768. You want to ask for Bryce Taylor, who's our new loans manager. Bryce will take awesome care of you. He's a great dude. And we will look at whatever you guys have got for us. But I urge you to go ahead and get as many funding sources and as much cash that you can have available to you for what's going to come, because there are going to be some great opportunities and you want to take advantage of those. Rocky, did you have any final remarks that you wanted to leave everybody with?
No, I think we covered everything. Everything's changing, and maybe we'll have another update in the next month or two, and happy to come back and share updates. And I spend most of my days talking to lenders, and I'll keep reaching out to them and find out what's happening as we go through this in the next few months. So yeah, happy to come back and share more information.
That's a great idea, you guys. We will give about 2 weeks or 3 weeks. We'll see what's happening, and then we're going to do another one of these. So be looking out for our notification about that, because we want to keep you guys informed so that you understand play by play what's happening in the markets. I do see one more thing that I want to say is I do see there's going to be a little bit of a feeding frenzy that's going to happen as soon as they open up the doors again. I think that's going to happen in real estate. But I think reality is going to set in when the kids go back to school on August 1st, and seasonally we see a slowdown in the fall. So I think you guys, if you have any properties that you've just purchased, or you're looking to buy some properties that you need to try to liquidate, you need to be prepared to have those sold, rehabbed and sold before the 3rd week in July, because once your window closes to sell those properties, you could be in a world of hurt, and you may end up holding on to them. And if you hold on to them too long, you could lose them. So definitely keep that in mind, that if you've got anything, we're going to probably see a quick feeding frenzy this summer, all this pent up demand. And then I think we're going to start to see reality set in August. So, well, I will leave you guys with that. I appreciate you joining us today, and we will have another one of these to inform you about what's going on in this private money lending industry in the next few weeks. Thanks for joining us, Rocky. I really appreciate all the input you gave.
Thank you, Corey. Thanks for having me.